please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
For now, let's invite our market master for the day, Tushar Pradhan, the CIO of HSBC Global AMC India, joins in to give us his view on all that's been transpiring so far. Tushar, hi, good morning. What's the advice to investors now? Is it time to sit back, sit on some cash and wait for this volatility or this dust to settle? Or do you think that the worst is behind us and perhaps it's good to deploy some money now?
I think what is very clear is that volatility, which has been almost non-existent, if you take the VIX as an example, or for that matter, even if you look at the local markets, that I think was something which was surprising a lot of people. People were worried that volatility seems to be dead, but I think it came back with a vengeance. And I think if you take the longer term average, I think volatility is back. Now, one need not be particularly perturbed by the fact that volatility is back. I think it signals more of a normal market behavior because markets are volatile. When there was no volatility, there was a fear that the markets have basically understood everything there is to be known. The signal that the central banks are giving is very clear that we're going to raise rates by a certain percentage over a period of time. There is adequate liquidity. So that led to a pretty significant drop in volatility over this period of time. But I think with the market now becoming a little uncertain about growth in general across the world, increase of inflation a lot more than most people's expectations, commodity prices firming up a little bit, all of that has led to volatility coming back into the markets, which I don't feel really very worried about because that's actually the normal for most markets. What's the advice to give to investors? Obviously, I'll stick to my longer term view that if you're an equity investor, then volatility is something that you need to kind of just digest along the way. We have to focus on long-term earnings growth. I think India is on the cusp of a recovery in terms of economic cycles, and I think earnings will follow. So I think I would kind of just say that sit tight and wait. I think the best is yet to come as long as you have a longer term view going over 5 years or so.
Okay, by the way, the mid-cap index is almost already in the green. So obviously there is recovery. The Nifty is off the low point. Is the bank still struggling? And while IT clearly is the big trade right now, which is happening, just keep an eye on Titan as well. That minor decline in Titan has been bought into. So, if you thought gems and jewelry would be under pressure, perhaps that's true for other stocks. But on Titan immediately,
that will be the one which will be advantaged, maybe.
Exactly. Perhaps the market is thinking that actually the unorganized players' loss is going to be Titan's gain, and that really has been the story with Titan. So obviously that is the one which is actually making the highs of the morning. But Tushar, good morning. So in terms of fund flows. Do you reckon that in spite of all the volatility that we have seen over the last 2 or 3 months, and February was a great testament that the fund flow situation is intact, do you think this market can absorb another 5 to 10% without impacting fund flows?
Well, I think the jury is out whether, what's the time that the investors really throw the towel as such. But I again would think that flows are really the outcome of what has been explained to investors for a while. In a sense, I think if the explanation is that the economy is on an upturn, we have probably the fastest growing economy in the world, corporate earnings are likely to improve. I think if that story is well digested, I think investors will continue to remain positive. Only if there is a substantial external event which would cause all markets all over the world to kind of react very sharply downwards. India will not be an exception. It will also follow the trend. And I think then there will be a test of patience for the domestic investor to say, well, should I then take some money off the table and then go back into cash or some other alternative asset? But again, I will emphasize the fact that volatility is the nature of an equity market. As long as investors understand that it is always going to be volatile in the short term. But if you focus on the fundamentals and if you focus on the fact that earnings are what drives stock markets over the long period of time, then I would hope that the investors will stay firm. But as I said, investors react, and if there is a very, very sharp downturn, then we can see some tapering off of the flows. But I don't think that is likely, given the fact that we've had almost a 10% drop since the peak that we have seen this year, and investors have stayed put. So I don't see why they will not continue to have the confidence unless there is a very sharp move downward.
Okay. Good morning, Tushar. I just wanted to pick the rupee for a minute. Can we just see? Looks like there is some bit of dollar buying that has taken place. So it's clearly 20 pice more expensive than where it began, or maybe 15 pice. Started off at 64.87. So it's a 16 pice more expensive currency at a time when there has been global dollar weakness. So there is a little bit, but I'm quite sure this is not a trade related thing. It could be more sentimental because of the way equity markets have fallen today. It may not necessarily be trade credit, which appears to be something which will be more long drawn as an impact, if at all. Okay, to come back to what we were discussing, Tushar, you have to get into the market now with a 5-year perspective, you're saying. What kind of sectors now should a fund manager hide in? Is it tech and pharma kind of stocks now?
Well, there is two ways one can think about this. One is what is cheap and one what is taken a beating. So the difference between IT and pharma, I believe, is that IT genuinely is cheaper compared to the kind of ROEs it generates, as well as its historical valuations in the past. Compared to that, clearly the sector is cheaper. However, if you look at growth, dollar growth in terms of revenues for most of the larger IT companies continue to be constrained. So it falls into something what I call as value, but not growth. So it's actually cheaper, but it's not relatively cheaper to the growth that one can expect out of it. So, but that's a place to hide. Pharma, on the other hand, is more to do with the fact that there's been a fairly sharp reaction to what has happened to the US FDA observations, and generally the atmosphere being vitiated by the fact that these companies seem to continue to attract some sort of regulation and action from the US FDA. There, if you see, that has actually led to a significant drop in production and by turn a drop in revenue and profits. And the valuations which have come off are actually in line with the drop in earnings. So which means that the multiple has not necessarily become cheaper. So that may not be a good place to hide unless you feel that the earnings are going to come back, these observations are going to be a thing of the past, and production as well as profits come back. But you have to remember that in the US, the generic market is made up of timing issues, in the sense that if you launch a product well in time, then you make the upside in terms of the prices. But if you come into the market later, the price power that you have, the pricing power that you have is much lesser. So even if you actually then can export and manufacture it back into the US, you may not get the same margins as you were expecting before these observations began. So I think all in all, I would think that it's an even bet. One has to be a little careful, one more selective about what one buys in pharma. So I won't this time.
Okay, so pharma is not a place to hide. What about banks? I mean, you have a large exposure to the banking space. In your HSBC India Opportunities Fund, you hold corporate banks like ICICI, you have HDFC, Yes Bank, IndusInd, etc. What have you made of all of these scams, the clampdown on short-term credit, the banning of LOUs, etc.? And what kind of a longer-term ramification do you think this could have?
Yeah, so I think we clearly have the belief that the India story is on its upswing, and that will have to carry the corporate sector and by in turn the banking sector with it. Now these observations which are coming out and the impact that it is causing is clearly a reaction to the events which have happened in the past. So all it means is that the impact on the stock price is something which was not discounted by the market given what has happened. Going forward, I think the better banks, the ones which are better capitalized, which have better access to the markets, so that in case that they need to require more capital, they can quickly come and issue stocks at a price to book level which is not really detrimental to shareholders in the sense that it is a multiple of the book rather than a percentage of the book. So I think it is more to do with the fact that the stronger banks, they will tide through this crisis and probably might be the future growth leaders. However, it cannot be said that all of the banking system is in healthy state, and clearly there will be some banks which will face trouble. So I think one has to be a little picky, but on the top, if you look at the banking sector from a top-down perspective, I think all of it is under pressure, and that's showing up in the prices. The fact is that these things are volatile. It will take some time before the market realizes which banks are more stronger than others, and then I think that's the bet we are taking in terms of where we think most of the stability still continues to be.